right, welcome to episode 17 of the ICT Mastery Mentorship. In this episode, we're going over institutional sponsorship, okay? Institutional sponsorship is not an entry model. It's not a PD, right? It's a confluence, okay? It's what's really going to give you your bias. So I will say long term. Not long term, but intermediate term. Long term is like over the course of months and years. But institutional sponsorship is basically when on a higher time frame, and I mean higher time frame is in daily and higher, so daily, weekly, monthly, those type of time frames, okay? On higher time frames, it's when price purges a low and there's immediate displacement afterwards, okay? So it's basically if, like, for example, if price came down below this low here, like let's say it came down, and this said, whoop, right back up. That's institutional sponsorship right there. That what this is telling you is basically like, okay, there's a institutional being or something in that is with a large amount of funds that is walking to the market. That's what that means right there. It comes down to a low, well, not specifically low, but some level of liquidity, and then immediately heads right back up with displacement. Okay, you know what displacement is? It's basically when price is moving extremely fast while creating fair value gaps. That's what displacement is. If you don't know what it is, if you're probably skipping episodes if you don't know what that is, but I have gone over it. But we're gonna go over some examples of this, and we're gonna implement it into some trade examples. Okay, so we're on NASDAQ. We're on a daily chart because, like I said, you want to look for this on a daily, weekly, and monthly time frames. But we're going to stay here on a daily. So looking here, we have this low right here. Well, really, all the way down to this low right there, wherever that is, sell side liquidity. Here we are. What price does? Price takes out the low. Wait, does it come and take out that low? Oh wow, even this low. So look at all these points of liquidity. One, two. This may seem stupid, but this is how my mentor does this stuff. I swear to God. We mark this all as sell side liquidity. Okay, give us a little second to mark all this real quick to make it easier for your eyes. So all this is sell side liquidity. Price purges all of it. Look at that, all that gone. Okay, all this liquidity has been hunted and purged. Okay, do you see how price immediately heads back up? It wastes no time. It doesn't meander around. It for a little bit it meanders around, but overall, what happened? Okay, what do you think happened? Overall, we displaced back up. So this is institutional sponsorship. So starting from around, I guess we can say this candle, because the institutional sponsorship really starts when the liquidity purge begins. So really, it's on this candle because this is the candle that purged all this liquidity. So this is where the institutional sponsorship begins. We purge these lows, or we purge the lows, and then we immediately displace back up. Why? Why do we say it displaced? You tell me what these are. You tell me what these are. What does this mean? You see these right here? What does that mean? What does this look like to you? Those are fair value gaps. So price is moving fast, and we can clearly see in hindsight it's moving up pretty fast while creating fair value gaps. That's displacement. Okay, so this is a valid institutional sponsorship because why? Took out the lows. Okay, then this candle right here is showing that we want to go higher because look at the way it closed. See how it came all the way back down and then all the way back up? Yep. Pretty cool, isn't it? Now, one thing I will tell you, okay, and take this for the future. Whenever you see a long wick like this, just a long wick period, okay, long wick like that creates a low, specifically, that creates a low. I will get some more information on wicks, but from what I know about wicks and what I've been taught so far, is that whenever you see like a very, very long wick, you want to draw that out, okay? Because with the wicks is the equilibrium of the wicks. It's like it's a high, I guess you could say a very algorithmic reference point. Okay, so you see how price creates, it comes down, purges liquidity, okay, and it comes back up, creates this gigantic wick, and then like that meandering around I was telling you, what did price do within that meandering around? It came down, it didn't touch the equilibrium, but it got pretty close. And then it said bang and headed right back up. So this is a institutional sponsorship with the tap of, I guess you could say, a phantom of orders. That's what I like to call a wick, because a wick is basically where price has been. So I guess you can call this like a phantom. Okay, this little wick here is where price was. Okay, that's where orders were flowing at. So you can call that an order phantom or whatever you want to call it. A wick. A wick is a wick. But that's how you use wicks right there for a confluence. Now, going back into institutional sponsorship. Like I said, we purged all these lows. Looking at this candle, We pulled ourselves all the way back up, showing that we want to go higher. We meandered around a little bit within this wick here, and then we immediately headed back up. Now, what is this here? What is that there? Market structure shift. See that? Yeah, breaking market structure. See that? So now price is shifting. Why does it break a market structure? Because we purged liquidity, then we came back, and bang. See that? Yeah, pretty cool, isn't it? Now there's these fair value gaps within the the break and market structure range from here to here. So you can use either this fair value gap or this one here. But me personally, I probably go with this one. It actually really doesn't matter. Whichever one that price respects, that's one we're gonna use. But price went past this fair value gap. Why? It's an order block here. Do you see that? It's an order block. Did it come to the order block? Oh, sure did. Pretty cool, isn't it? Bang, right on the order block, and then it went higher. So this institutional sponsorship combined with this break and market structure, was confirming or really made the market shift. Okay. The institutional sponsorship, what this pattern is, it's telling you that some large institutional being or someone that has a lot of funds that's institutional, obviously, has walked into the market. Their presence is there. That's what this shows you, okay? And it's all institutional, okay? It's all price action. It's not like, oh, we're seeing overbought, oversell. No, come on, really, really, like, come on, really, like, come on. I'm not gonna show you about that. We're teaching all price action here. If anything, the only indicator I'll probably show you just to assist you is the kill zones indicator, which is this one right here, the Lux Algo ICT kill zone toolkit. Now I will give you some things to help you throughout this mentorship, but that is institutional sponsorship. I'm gonna show you some more examples of this. Okay, we might go on gold. Actually, for example, let's go on gold. Well, let's go on euro because I do have a lot of drawings on here that I can go ahead and delete. All right, delete drawings. So now we're here on euro on the daily chart still. But let's jump up to the weekly, shall we? Let's jump up to the weekly. So looking here, we're in a major consolidation, okay? But we're not talking about that. We're just looking for, strictly institutional sponsorships and where they occur because that's what I'm trying to teach you. So we have these 2 points of liquidity up here. We have this high right there, and then we have this high. Which one did price come to? Came to this one. So this is a liquidity purge right there. Price didn't come to that high. So we're looking, price purge this high. Why do we say purge? It's because we can clearly see that it did not want to go past it. It went past it a little bit, but looking at the candles afterwards and the way they were looking, it didn't look like it wanted to go past it, did it? No. We purged liquidity, and then we were showing signs of displacement. Why? Because look, pay attention. Oh, pay attention. Open your eyes. One. See that? Hold on. Let's go again. Hold on. One. See that? It's getting crazy, isn't it? Hold on. We're ready. Hold on. Ready. One. Yeah. Hold on. You see it? See that? Hold on. Ready. Hold on. One. You see that? See that? That's displacement. Okay. So this is what? This is officially institutional sponsorship. Okay. Right here. Institutional sponsorship. Okay. We came up to the height. And then we showed that we did not want to push through this high because look at the candles look. So that confirms that this is a liquidity budge. Understand? Yes, I understand. JJ. I understand. Okay, good. You understand. So we now want to see some form of displacement. We want to see price move down very aggressively, which will show that there's an institutional sponsorship. One fair value gap. Once you see one fair value gap, that's all you need. Just see one. When you have one fair value gap, that is perfect because that shows displacement. Okay, whenever you see fair value gaps being, created, that means that there is displacement. Okay, that's what displacement is. Whenever price is moving too fast and there's too much of one side of the market. I taught you that in the fair value gap episode. Okay, whenever price is moving too fast, price will create fair value gaps, and within those fair value gaps, there is a displacement or an inefficiency of one side of the market. That's what that means. So whenever you see a fair value gap after prices purge liquidity on the higher time frames, remember that on the higher time frames. Once you see one fair value gap, that's your displacement. That's showing that a being has come to the market. So this is officially institutional sponsorship. Now, how could we have taken a trade on this? How? What could we have used? All right, let's think here. So let's delete all these fair value gaps because I was just honestly yapping with this. All right, here we are. Hey, let's look into this, okay? All right, so we do have a market structure shift with an institutional sponsorship. So that's already that. You know what I'm saying? Break a market structure, and then we do have a order block here also. Wow. Hey, see that? See that? So you can either use the order block as your entry. Remember that you can either use your order block or you can use the fair value gap as your entry, whichever one you want to use. Me personally, I'd probably go with the fair value gap because how close it is and how close it is just we're just with an order block. I'll probably use the fair value gap just to get an earlier entry because sometimes what price will do is it won't come to the order block. It'll just come straight to the fair value gap and then drop. But in this case, it went to both and then it said, okay, bye bye. Okay, so me personally, I would take the fair value gap. Let's just say you're using my head or you're my brain and we're just gonna set it right there. Set my stop right there at the top of the second candle. And then where do you want to target? Okay, you got these three lows here. You got these three. Me personally, I would go down here. That's just me personally. I would go down there. Okay. Right there, I got sell side liquidity. Now did it work? Let's see. Let's drag it down. Hold on. Let's see. Boom. Look at that. 6.5. Do you see that? It's absolutely amazing. That's your trade right there. That's if you're a long-term trader, of course, because that's 1, 2, 3, 4, 5 weeks, which is almost a month, basically. Is it a month? Yeah, that's a month. That's officially a month. From here to here, those 5 weeks, that is an entire month. So, yeah, that's your trade. Okay, you want to look at it one more time? Sure. Let's go over it one more time. Let's go on gold. Okay, let's go on gold. Why not? Okay, let's see if we can find one for you. Let's see if we can find one just for the student. Okay, let's see. So we have this low here. We have two lows actually right next to each other. So these are relative equal lows. So we can mark both of these as sell side liquidity because they're relative equal lows. Price comes down, purges liquidity, and we can clearly see that it doesn't want to push through it because as soon as we came down here, what do we start do? Meandering around, meandering around, meandering around. And then look at that. Boop, pop right back up. Boop, look at that. Boop, like someone flicked it. Like someone flicked it back up with their finger. Like imagine flicking the coin up in the air. That's basically what happened here. Purge liquidity. I was like, boop. Once you see that first Ferrari gap, that's how you know that something is into the market. Once you see that, bang. It's like, okay. It's like, all right, something's here. Something is here. You know what I'm saying? Like once you see that, it's like, all right, let's think here. Like, that's all it is. But let's go over a trade example here that you could have took. So looking here, we do have this latest high here. So what is that? Breaking market structure that confirms that price is shifting. All right, so we got a breaking market structure right there. Now, what fair value gap would you have taken? This fair value gap, yeah, but is it within the range here? Kinda, but not all of it is. So we can drop down to the daily and go back to that same point in price. That same point right here. That fair value gap, yeah, but is it within the range? Nope, not at all. It's outside of it. So what could you have taken? Jumping back on the weekly, what could you have taken? Let's really look here because I have to put my I guess you could say my brain into how you think because I don't know everything. You don't know everything that I know. You're a beginner. Very simple, right? You're a beginner. But what you could have taken was either this order block here, once it like came down into it, and then that would have been your entry there, and that would have been perfect. Or you could have took one of these fair value gaps, or even this order block here. So whichever one you want. But order block after order block, and order block still works. So we can take this one. If we draw our buy position, we can set it right about there. Set our stop loss at the bottom of the order block, right there at the bottom of the order block. I can pull this over. Geez, it's taking a while. And we set our target at this high here. We drag it over. Bang! There's your trade. Pretty cool, isn't it? And obviously, you're not trading on the weekly time frame. Okay, I'm just saying, if you were a long-term trader or if you're just implementing this into your trades, this is how it would look. I'm not saying go trade on the weekly time frame. Do not do that because if we look here, this literally took how long did this take? This literally took like a year and 2 months. So obviously, we don't want to wait that long just for a 7 risk reward. I mean, 7 risk reward, 7 risk reward. But you can probably do that like 3 times in a single week than waiting a year and 2 months for it to happen one time. Okay, like it's just common sense. But on a real note, I'm going to be ending this episode here. I hope you learned about institutional sponsorship without getting confused because I am talking kind of fast, and I do need to slow down. But seriously, I'll see y'all on the next episode, and I'll be in this one here. Peace.